Hello and welcome to Quant Matters, where we talk about the quantitative approach to investing and finance. Today I want to talk more about risk, specifically what types of risk there are and how to quantify them so you can use them in your quant strategies and investments. In a previous video, I briefly talked about risk as being a measure of uncertainty. That is, if you know for sure that some outcome will happen, then you are not at risk. Likewise, if there is some uncertainty, you are at risk. I usually like to land concepts in outlandish reality to clarify them. So let's say you have two doors with some price inside. There's a window in one and you can see an empty room and a price. The other door has no window, but there might be or might not be a man-eating tiger inside along with your price. You have no risk on the first door and a potential life-ending risk on the second one. I also mentioned that risk can be quantified with the use of probabilities. That is, there is a 0% probability of being eaten by a tiger on the first door, and an unknown probability or uncertainty in the second door. As investors, the doors represent investment opportunities, returns being the price, and being eaten by the tiger means the investment lost money. I briefly covered the different types of investments and the risk profiles. That is, what kind of price you get against what probability of being eaten. What remains now, and what this section is about, is the different types of risks that are lurking behind those closed doors, and how to quantify them. In other words, and stretching the analogy, behind the closed door there could be not only a tiger, but a man-eating shark, a bunch of angry monkeys, a trapdoor, and some quicksand. The first and probably most terrifying risk out there is risk of ruin. Here, your investment or asset goes to zero or close to it with little to no opportunity to recoup your losses. There is no hard data on risk of ruin on most individual assets, as this will entail knowing when, how, and why they would lose their value, with the exception of assets like options designed to expire and go to zero. Besides doing research on an individual asset, we can summarize the approximate probability for asset classes based on their survivability through time. Before discussing the next types of risks, we need to define expected return, which serves as a reference point. When we invest in an asset or design a strategy, we form an expectation about its future performance based on past data. In practice, this expectation is often estimated using the average historical return of the asset over a chosen period. For example, an investor in SPY, which tracks the S&P 500, might expect a long-term average return of around 10% per year based on historical data. As a side but critical note, predictions, which is what we're doing here, especially ones based on their past to predict the future, are neither fixed in time nor fixed in accuracy, or in the common disclaimer form. Let's say you were expecting a 10% return on your asset over a certain period, but at the end of that period you ended up with another value. Could be 5% or 15%. Your expectation was wrong, and while you probably won't complain about a greater positive return, the lesser represents a risk for your strategy or investment. Volatility, in essence, tries to quantify this discrepancy, or how wrong can you expect your expected returns to be. Formally, we can define volatility as a dispersion of returns around an expected value. In math parlance, it is the standard deviation of returns. In general, low volatility equals high certainty, and low risk, while higher volatility equals lower certainty and a higher risk. While standard volatility treats positive and negative deviations from the expected return equally, investors are usually more concerned with outcomes below their expectation. Using the same example, if you expected a 10% return, ending up with 15% represents a positive surprise, while ending up with 5% or a loss represents a negative one. Downside volatility focuses only on these negative deviations, since they are the ones that pose a risk to the investment or strategy. Formally, downside volatility measures the dispersion of returns below a chosen reference point, typically the expected return or zero. In mathematical terms, it is the standard deviation of negative returns only. In this sense, downside volatility is a more targeted measure of risk, as it captures uncertainty where outcomes are worse than expected, while ignoring upside variation. While volatility and downside volatility describe how returns fluctuate around an expected value, drawdown focuses on realized losses over time. A drawdown occurs when an investment falls from a previous peak to a lower value. For example, If a portfolio grows to a certain level and then declines before recovering, the size of that decline is its drawdown. Unlike volatility, drawdown is measured in absolute terms, as a percentage loss from the peak. Formally, drawdown is defined as the decline from a historical peak to a subsequent draw. The maximum drawdown represents the largest such loss observed over a given period. Drawdown is a critical measure of risk because it reflects actual capital lost, not variability. Large drawdowns reduce capital, limit future returns, and may force investors to exit positions, making recovery difficult or impossible. There are a few more risk types you should be aware of. These are somehow more complex or secondary, so I'll just briefly mention them for now. Correlation risk refers to assets moving together, especially during periods of stress, reducing the effectiveness of diversification. This is a critical concept and will be covered separately in a dedicated video along with diversification. Liquidity risk is the risk of being unable to exit or rebalance positions without significant price impact, particularly in stress markets. Sequence risk arises from the order in which returns occur, where identical long-term returns can lead to very different outcomes depending on timing. Inflation risk is the risk that investment returns fail to preserve purchasing power, resulting in real losses despite nominal gains. Now that you have a basic understanding of risk types, we can start quantifying them through real assets. Note that there are no set standards for periods, but more like conventions. So I'll try making this industry aligned. Let's go metric by metric before combining them into a final table for discussion. The assets we will use are SPY, the S&P 500, GLD, that's the gold ETF, IEF, that's a bond ETF, and Bitcoin versus USD, the currency. The first thing we will need are historical prices series for these assets. I am using the daily 2025 prices. We cover how to get them on Google Sheets in the Portfolio Basics video, so go check it out if you have questions about this step. Note that most likely you will need to clean and align your series. Bitcoin, for instance, trades daily, which stocks doesn't. So also check for empty cells and things like NAs and nulls. Once you have daily price data, the next step is to get daily returns using the percentage change formula we also discussed. Once you have a column of daily returns, the next step is to average and annualize them. Here's the formula. Using 252 days to annualize a daily average is one of those conventions I mentioned. Once you're done with the other assets, you should have a table like this one. For volatility, we already have the daily returns. We just need the standard deviation along with a way to annualize it. Here's the simplified formula. Or in Google Sheets, where the H column is the returns column. In order to get the downside volatility, we just need to filter for negative returns. Or in Google Sheets. Once more, repeat for each asset and you should complete the volatility table. Calculating drawdown, especially on a spreadsheet, is a little trickier. Drawdown, if you remember, calculates the biggest change from peak to trough during a certain period. How bad of a crash, either a slow one or a fast one, the asset experienced from its top. So in order to calculate it, we need to keep track of the highest peak. The first step is to simulate what a running capital will generate based on the daily returns. Imagine if you invested $1 and added or subtracted from it based on the daily performance of an asset. This is what the cumulative columns are for. The peak columns keep track of the highest running value, comparing it to the previous value. If it is greater, it becomes the new peak, else the previous peak remains. The drawdown column then calculates the percentage change of the current running value against the peak. All that remains is to find the highest drawdown value, which we do in the final table. Here's the final table you should have. As a reminder, this is only for 2025. You probably want at least 10 or 20 years for a comprehensive picture, but even with a single year, you can get some insights and understandings on the risk metrics, which is the focus here. As expected, bonds carried the lower risk and return. Gold was the outlier with a greater return than stocks, pointing to a flight to safety, but not a complete retreat, as stocks still perform well. yet had a lot of choppiness. The 19% drawdown points to that. Bitcoin's risk metrics are not great, as it provides a meager return for a lot of risk. Before wrapping up, I should mention that while risk metrics are great indicators for your investments and strategies, they can be hard to read by themselves. So while plotting stocks deserves its own discussion, I included some basic plots on the spreadsheet that can help you better understand things. For instance, you may be wondering when the 19% SPY drawdown happened. A simple plot like this one showing the peak and drawdown helps. I also added basic pricing plots that can help you understand what happened during the period you are analyzing. By now, I hope you have a better understanding of some of the major risks for your investment and strategies. In addition, you can now start quantifying them and organizing them across assets so you can get a better picture and insights on strategies. While we focus on risk types, there are of course risk mitigation strategies, and I hope to cover those in the future. But even at this stage, just knowing about them helps. I think in investing, as in life, it is not always that we can't deal with a certain negative outcome, but that we miss one or a few other types of risks that actually materialized. Thanks for watching, and if you want more Quant content, please consider subscribing to Quant Matters.